Hi everyone, in this video I'm going to go through an example of straight line depreciation. What we'll do is we'll take the same problem here. Here's our sample problem and we'll create 3 videos. This first one will be on straight line method, the second one will be on the units of production method, and the third one will be on double declining balance. So let's just go right through this straight line method. This is the one that's the most straightforward. The facts are very important here when you're looking at these problems. How much did I pay for the equipment, or how much did I pay for the asset? Here we're paying for electronic payment equipment and we paid $27,000. That's an important fact. That's my cost, and that cost is going to go all over the place. And I'm actually going to enter that into my first step here, which is my cost of $27,000. Next thing I really want to know is what's my residual value of the equipment, and that's given to us straight there in the facts, $1,500. So I can complete my first step right there in the first 2 sentences of the problem. My depreciable cost then becomes cost minus residual value is $25,500. So pay attention to this number. I'm going to show you how this comes into play later. This is telling us how much depreciation do I take over the life of this asset. And in this case the asset is 3 years, and I'm going to build this schedule, and once I'm done building the schedule, my ending accumulated depreciation should be equal to my depreciable cost. It also says the equipment expected to process 255,000 payments over its 3-year useful life. Per year expected payment transactions are this, this, and this. Now, we have enough facts already to calculate straight line depreciation without these last 2 sentences. These last 2 sentences will be used in the units of production method, so we're not going to pay attention to those right now. All we need for straight line method is our cost, residual value, and actually this little fact right there, 3-year useful life. How long is that machine going to be good for? So in this case it's 3 years. So what I do is I take that depreciable cost that I just calculated, $25,500, and divide that by my 3-year useful life. And once I do that division, that's going to give me my depreciation expense per year of $8,500. So step 1, step 2, straight through there. Once I have that $8,500, what I'm going to do is I'm going to start filling out this schedule. So when I buy my machine at acquisition, there's no depreciation expense because I didn't use it yet. You can only have depreciation once you start using the machine. So we're going to have $0 in my depreciation expense. Now, what did it cost me at acquisition? It cost me $27,000. How much depreciation have I taken once I buy the machine? At the moment I bought the machine, I did not depreciate the machine yet, so my accumulated depreciation is 0. And then my book value becomes the $27,000 minus 0. So it's still worth $27,000 right when I bought it. I bought it for $27,000. That's what the whole value is, because I didn't take any depreciation yet. Now my balance sheet, my equipment account is going to look like this: $27,000. Let's put these in dollars. $27,000. How much accumulated depreciation I take? 0. And in my book value, which is my net equipment, is going to be $27,000 purchase price minus my accumulated depreciation. Minus that. And I've taken 0 depreciation expense. Alright, year 1. Now I start using this calculation. After 1 year has passed, I will take $8,500 of depreciation per year. So that is my depreciation expense for the year. My cost, how much did the asset cost me? It still cost me $27,000. Unless I had any improvements, which I did not according to this problem, my asset still cost $27,000. Accumulated depreciation. So what am I going to do for that? I'm going to take last year's accumulated depreciation, which is 0, add this year's depreciation expense, and I will get accumulated depreciation. That's all I have to do every time in this column. Last year's accumulated depreciation plus this year's depreciation expense equals accumulated depreciation. And my book value becomes always cost minus accumulated depreciation, $18,500. And put that in here for year 1. At the end of year 1, my balance sheet will have $27,000 for equipment as the value of the equipment. We always keep it at the price we paid, minus accumulated depreciation, which will be negative $8,500 on the balance sheet, equals our book value. And actually, since that's a negative number, let's add them together, $18,500. See how this equipment net matches the book value in our table. And then my depreciation expense on my income statement, which would be in my operating expenses section, would just be $8,500. Alright, and then just keep going. So now we're at year 2. 2 years have passed. In year 2, I take another $8,500 of depreciation right from my formula. My cost still is $27,000. That's what I paid for it. Accumulated depreciation. So you take the year before, the $8,500 that we already had in accumulated depreciation, and add this year's depreciation expense, and I get $17,000. My book value becomes $27,000 minus $17,000, or $10,000. Go to the balance sheet. You don't have to do this in your homework problem, but you need to know where this chart maps to the balance sheet and the income statement. This is how it maps. I'll still have an equipment asset worth $27,000. I would have accumulated depreciation of negative $17,000, and my net would be the sum of both of those. $27,000 minus $17,000 would be $10,000. Finally, year 3, it's another $8,500 of depreciation expense. See, every year, same depreciation expense under straight line method. My cost is still $27,000 accumulated. Take last year's accumulated depreciation, which is $17,000, add this year's depreciation expense. There's your accumulated depreciation after year 3. Book value, cost minus accumulated depreciation equals $1,500. And let's go to the balance sheet. $27,000 minus $25,500 minus my accumulated depreciation, that goes right to the balance sheet, equals a book value of $1,500 for my equipment. Notice what happens here. By the way, my income statement has $8,500 of depreciation expense each year. So let's make a couple notes. 1, look at my accumulated depreciation after year 3. It is the same as my depreciable cost. Basically, it's saying, how much depreciation should I take? Well, look, I took $8,500, then $17,000 after 2 years, $25,500 after 3 years. So it matches. That was my goal of this whole schedule, is to take $25,500 of depreciation in 3 years. Look at my book value after 3 years is over, $1,500. My other goal, I want my book value at the end of this table to be equal to my residual value, and it is. So that matches up. And then one other thing to keep in mind is look at your income statement. Notice the difference between depreciation expense and accumulated depreciation. Depreciation expense is how much depreciation did I use this year, and then accumulated is how much have I taken out since I bought the machine. So after year 3, in year 3 I have $8,500 of depreciation expense used, but at the end of year 3, what is the amount of accumulated depreciation that I've taken? It's the $8,500 times the 3. So keep that in mind as we work through the other methods. Those same concepts are going to apply. So the next video will get you into the units of production.